All right, everyone, we're going to go ahead and get started. I'm Emily with Broker Online Exchange, and I'd like to welcome you to our May Energy Market Intelligence webinar. We're glad to have you back if you were with us last month, and if not, we're glad to have you today. We do these the last Wednesday of every month. I'd like to start off with a quick poll to get a feel for who our audience is today, so take a look at the question and let us know what your role is in the energy industry. Thanks, everyone. I'm going to go ahead now and turn it over to our energy market analysts, Elliot and Brian.
Hi, everyone. My name is Elliot Chorn. I'm Vice President of Retail Pricing at TrueLight Energy, and I'm joined today by my colleague Brian Stanton, who I'll let introduce himself and dive right into our wholesale market download.
Yeah, hi, afternoon, everyone. Brian Stanton here. I'm a partner with TrueLight Energy, and one of my key responsibilities is market intelligence, wholesale commodity prices, how it impacts retail price trends, and then helping manage portfolio and risk management for clients and brokers that we work with. So if you're returning, thanks again for coming back. If you're new, what we try to do here is help provide some talking points, demystify what's going on in wholesale, natural gas, and power curves, to give you tools to have more intelligence conversations and help move your customers to a decision on wherever they're at with respect to their energy purchasing decisions. So we have about probably 8 or 10 slides. We try to keep it open and loose, talk about high-level trends. There'll be an avenue towards the end to put questions to us that we can address. If we go too deep or too narrow on something, that'll be your opportunity to get a better explanation. So, or to
right, Brian,
try to see what we're at about.
Let me jump in there real quick. Do encourage you to submit any questions through the webinar software. Go to webinar software throughout the meeting, and we'll address those at the end of the conversation.
All right, cool. So Emily, if we can move on to the first slide, that'd be cool. All right, so what we're looking at here is a curve of the near month natural gas futures price on the New York Mercantile Exchange, also called the NYMEX. This is the Henry Hub price quote for the contract that expires next month. So it's kind of a rolling forward look, and it displays the normal kind of volatility you'll see in forward prices for natural gas futures. It's the best proxy for what the market expects to happen with respect to the future price of gas. The next slide that we're going to look at is something called physical spot gas, which is essentially where gas settles for actual physical delivery. This is a financial contract where folks can hedge or lock in prices for their expectations and use a financial derivative to protect their exposure or to take advantage of some market speculation moves. But it paints a pretty normal picture. Things were pretty stable from Jan 17 till Jan of 18 in a tight range. You barely got off of the $3 number. But then, if some of you recall, in the wintertime, you see this large spike that starts in late December and kind of culminates in the end of January. Winter was pretty extreme. A lot of use for residential and commercial heating of spaces, especially in the Northeast and the upper Midwest. You'll hear things like heating demand and cooling demand. Heating demand generally means residential or commercial footprint spaces that use natural gas to heat. Cooling demand is about electricity for air conditioning. So, for example, Northeast is a heavy heating demand use state, so prices spike there in the winter as opposed to the summer. Conversely, the Southeast and Southwest and California area, the more volatile price experiences you're going to see are in the summertime when you flip on the AC and a lot of power plants come online to meet that demand. A lot of those tend to be natural gas using plants. So all of our stories start with what's happening in the NYMEX market. As as we exited the winter, we saw a return to something that we call the normal shoulder period. In the spring and in the fall, we tend to see more periods of less volatility in gas and power curves. Unfortunately for us, as we'll get into a little later, we had a very late winter, meaning that March was below normal trending for a majority of the country, especially in the heavy gas markets of the North Sea. So heating demand kind of stuck around later than normal. So we didn't have as deep of a spring shoulder period as we would have expected. And then as we take a look at the weather chart in a couple of slides from now, you'll see that summer is getting started with a bang. This Memorial Day weekend is going to be setting records from Texas to Southwest to Southeast and all the way up into the Upper Plains. So you've got probably better than 50 to 60% of geography of the country printing above average temperatures in a meaningful way, meaning double-digit above anomalies. And things are pretty also trending to warmer than normal in the Northeast. So you've got a picture that says, we had a late end to winter and an early start to summer. So our shoulder period, which is generally the time in which you have a chance to kind of avoid some volatility and make some long-term decisions, it kind of came and went. And we'll touch upon that a little more later. So the move in that curve in the gas and power curves has all been about anomalies to the upside for unexpected above average temperatures for majority of the load centers. We can go on to the next slide, please, Emily. I alluded to physical gas spot curves. This is, again, just a picture of that. Everything being equal, it tends to look a lot like what you saw in the previous slide for the financial curves. But the anomalies here in Jan are a function of very large demand on the system in short-term bursts. We were printing in the 7 and 750 area for some parts of the country. So all things being equal, this curve will move in tandem with the financial gas curves. But looking backwards, for example, physical gas settling prices are going to tend to be very different from forward gas curves. So, for example, looking on how things settled up last week, Chicago Citygate, which is the proxy for the upper Midwest, those gas prices are up about 11% week over week. That's a big move for Chicago. California prices were above average as well. We saw Northern California pricing moving up about 5%. Southern California prices, that's about LA, San Diego area, those prices were down about 20%. What's been going on there is high demand on the system in the north, low physical capacity constraints in terms of getting physical gas through pipelines to where it's needed. You can have demand on the system if the infrastructure is not there to meet it. You're going to have short-term interruptions, and that's been the story in California. Southern California prices, that kind of downward trend is unusual, but the volatility has been very strong there. Weather in Southern California has been trending, hot but below normal, so some of this demand has been coming down. Northeastern prices were generally higher, again, for maintenance on the system of pipelines. So anywhere from, the PJM area prices in the northern part of Pennsylvania into the Mid-Atlantic footprint, those numbers were up about 50% week over week. New York City prices were up about probably about 40%, and then Boston prices were pretty flat. And that's all a function of the fact that in the spring season, the gas infrastructure system schedules planned maintenance on their pipeline system. So they'll bring down compressors, they'll bring down physical pipes, they'll reroute gas. So they'll impact the ability of the system to meet demand. All things being equal, that's usually the smart time to do it, but Mother Nature does what it's going to do. You're going to have short-term spikes when there's normal demand on a system that's constrained because of maintenance outages. So a fair amount of systems in the Northeast, all the way from Pennsylvania up into Maine, have been, doing maintenance, and that's been kind of causing some short-term anomalies on the price points. So let's see, Emily, what's on our next slide? I think it's supply and demand. Okay. This can be a misleading slide. Sometimes it's interesting to look at. Sometimes a picture of stability, which we don't always get to see. The I guess it's orange-ish line is the supply side of the equation, production, imports from Canada primarily. And generally speaking, it moves very little. You're going to see a week-over-week change of plus or minus 1% is normal. It's also fairly normal to see no change at all. A large change would be 2 to 3%, and that's usually a function of a production facility going down unexpectedly or something happening to imports. Price points being so attractive that Canadian flows stay where they're at instead of coming to us, or vice versa. Prices are so high, a bunch of Canadian producers ship product to us, and you'll see that move around. But week over week, and what happened this week was no exception. The supply side was pretty stable. We saw production up about 1%. It hovers around 80 to 85 BCF a day is kind of where you tend to see it. And you saw some moves to the upside Canadian imports, mostly because price points were moving, physical gas prices that you saw in some of those key consumption areas. Those price points are very attractive. So Canadian producers tend to try to take advantage of that. The demand side of the equation is what you see a lot of movement by. That blue line tends to swing, some real wild numbers. So the fact that you're looking back in that winter of roughly December to January into the early part of 18, the fact that demand spikes way up, that's consistent with that physical spot curve we saw on the previous slide. When demand goes way up and production doesn't meet it, the prices are going to react. So that's why supply and demand is such a big point of what's happening in the physical gas markets. Last week, physical demand for gas was down about 1%. Power burn demand is generally was about 3% lower. That's generally a shorthand for gas that's being shipped to power plants, and that's a function of cooling demand. So, week over week, things were stable temperature-wise. Again, it's a look back. It's not we talk about the fact we're going to have some extreme weather now and coming into next week. The supply-demand picture lags about 7 to 8 days. So it's reflecting what was happening about a week ago. Let's see. Industrial sector use was steady, about 20 BCF a day. That's a normal number. It doesn't move a lot either. Not a big variable. Tends to be pretty stable. The residential commercial consumption was down 1%. No surprise there, because in the Northeast, where a lot of folks use gas to heat their homes, things have been pretty nice. So there hasn't been a whole lot of heating demand, not a whole lot of cooling demand, which is what you expect to see in May in the Northeast. And then exports to Mexico came down about 1%. LNG exports have been creeping up, but they were down week over week. We're generally putting together about 18 to 20 BCF of gas on ships and shipping them out every week to various international markets. Not a huge number, but it's been creeping up. And as other corporations set up LNG export facilities, it's going to become more meaningful in the demand side of the equation going forward. So let's see the next slide, if you please. All right, there's our weather slide. So we have a short-term and then a long-term weather slide. So this picture kind of illustrates what I've been trying to get at earlier. This is a view published by NOAA, National Oceanographic and Atmospheric Administration. They're the gold star standard for public information with respect to forecasting. No one says their model's better than any others, but this is what everybody starts with, and this is what's out there in the public domain. It's what we use. And they generally are pretty good, especially when you look at short term. Short term here being valid from May 31 to June 8. So that's that's like a 0 to 5 day window. And the anomalies are very strong to the upside. Anything that's yellow to maroon and red is above average. So you see the poor people in Texas are going to be seeing their first 95 to 100 degree kind of days starting now, and that trend seems to be pretty strong for the next probably 8 to 10 days. If you take a look at this pushing out longer, weather forecasts tend to degrade in their accuracy after 14 days, but they are pretty accurate up to that 0 to 14 day window. You got anomalies to the upside anywhere from Texas all the way up into the upper plains and spreading. West Coast trends a little bit below normal. Even the Northeast has some above average pockets as well. So, for at least for the next 6 to 10 days, majority of the country is going to be seeing above average weather early for the summer. First week of June, having triple digit numbers in Texas is not normal. Maybe people in Texas will tell you stories about when it's happened before, but it's certainly doesn't live within the realm of what's expected on a normal time. And that spikes demand on the system. That spikes demand for power plants using gas, that strikes demand in your power curves, which we'll get into in a few minutes. I think the next slide is a month-to-month look, or the next 30 days. Yeah, this is okay. This is a 3-month view. This is valid for June, July, and August of 2018. So this is the current view of what they expect the summer to look like, the 3-month window. Again, things are less accurate. Obviously, you've got an even chance of a normal system happening for the Upper Plains down to the Mississippi Valley. It looks like Kentucky to Tennessee, roughly to northern Arkansas. That little bubble coming out of the north will be calm and normal, above average in the Southwest, a little above average in Texas, and then trending above normal east of the Mississippi. That's a bit of a push, as I just alluded to. Accuracy on the 14-day window is not terribly great. So, I mean, the best thing to do is plan for a normal summer and then hope for the best. But as the short-term anomalies flow in, you see that what we're going to see is going to be contributing to more gas price volatility and more power price volatility. Moving on to the next slide, if you don't mind. Okay, this is a quick look at Headroom. Elliot, this is your purview. Would you mind carrying us on there?
No, not at all. So Headroom is really just looking at what the utility price to compare is and what a current retail contract with a prompt month start. So in this case, that would be a June start would be, what a reasonable retailer would charge for that. Not currently seeing a large amount of headroom across the country. Really the only markets that we're seeing any appreciable headroom are Massachusetts. In this case, this is WMECO, now known as Eversource in western Massachusetts. You can see there's definite headroom in the short term, but as you get out into the longer terms, headroom is definitely decreasing. Similar story across most of Massachusetts. Some of Connecticut is similar. The only other markets that we're seeing any appreciable headroom would be JCPL and Atlantic City Electric in New Jersey, and then Potomac Edison in Maryland. Reason that we're not seeing any particular headroom, last summer had a relatively mild summer and a mild lead up to this past winter when a lot of the utilities were doing their procurement for their summer 2018 pricing. So low prices during that hedging activity. And then that's on the other side is what Brian's been talking about is this extended heat, shortage in gas in comparison to some of the 5-year numbers, and overall just kind of buoyancy in pricing for both gas and power strips for retail suppliers that would be hedging under current market conditions. So not seeing any current headroom or very much headroom currently across the country, but do expect that to start to shift as we exit the summer, where utilities are currently procuring for their winter time period and are having to buy into that little bit of a higher priced market that we're experiencing on the retail side currently.
All right, lovely.
Yep. Next slide.
Okay, so in keeping with that theme, now we're going to come back to what's been happening in the WMECO strip. It's funny, I never heard WMECO. I think I'm not going to be able to unhear that. Thanks, Elliot. I always heard West Mass for up till now, but okay. Anyway, so here's a long-term view of what's been happening to the rolling ATC. And for you guys who aren't up on the lingo yet, ATC is around the clock power curve. This is just as Elliot covered, that with the previous slide, Headroom referred to an all-in fixed price, fully baked price to a retail customer, which includes everything from energy plus all the extras. This is just a view of the energy strip, and as you guys know, the energy strip is really the source of the greatest volatility in price points, because most of the other things are either baked in for a tariff or for a demand tag or a capacity tag, and tend to move much less egregiously with respect to price points. So if you want to take a look at what's happening in the market, the energy strip alone gives you all you really need to know about inter-seasonal price volatility. So what's been happening is, we saw, I'm focusing on the right-hand side of the curve here, roughly, from year end of 17 up to now, we saw that winter spike happening in late December. Even in fact, it started in late November. December was a pretty rough month to the upside, and it kind of happened in Jan, and then everything kind of fell out of bed again in Jan, and things corrected into the March timeframe. And then since March, we've had this slow creep up again. So the volatility in the price curve has been pretty active. The Northeast West Mass curve is a good example. NEMAS is the other side of that footprint into the eastern part of Massachusetts. And then really, when you get right down to it, any load zone in the NEPOOL area, they're going to be a lot more volatile because it's a very gas-intensive system. Conversely, a ComEd curve in the Illinois zone for PJM is going to be less dependent and less volatile because there's a lot of baseload nuclear units out there. So when you get into the Northeast power curve view, you're going to see a lot more price volatility. But what's been happening here is this curve does a lot to mirror what's happening in the gas markets as well. And what's been happening in the power markets has been pretty rough. The Northeast, for example, week over week, we saw NEPOOL price points move up anywhere from 2.5% on the 12-month strip. That's a big jump for a weekly power curve in the Northeast. The ATC curve in the NEMAS is probably printing right around $44 now, so that's not cheap. The 24-month strip covers a 2-year window, is up about 2%, and then calendar 19 is up about 2.5%. So those are all pretty healthy upside moves for NEPOOL. If you think about what's been happening in the NISO Zone J, which is New York City, the most volatile point, the most price-sensitive point. Again, keep in mind a large amount of gas supplier systems have been doing maintenance, so there hasn't been a lot of gas getting into New York to meet demand there. You've seen those price points up anywhere from 1.5% to 2% for the 12-month strip, printing at about $41 a megawatt hour. The 24 months up about 2%. The calendar 19 is up about 1%. Not huge, but still pretty surprising upside. You don't see that a lot. ComEd curves, 12 months prices are up about 2%. 24 months up about 1%. Cal 19 is unchanged. That's flat. That's a little more normal for the Illinois market. But there's a lot of short-term heat happening in Chicago, and it's a very intensive cooling demand kind of system when that happens.
Brian, are those week-over-week price movements?
That's week-over-week price movement. That's what was printing like basically Friday before the holiday weekend.
Just to add a little bit to that, some of those numbers, if we look back a month or 2 months, grow even larger. Those of you that have been on the call with Brian and I for the past few months, we're pretty strongly recommending, getting your customers locked in during that shoulder season as we came out of that kind of below average March time period and then going into that April time period. Brian and I were talking earlier, and Brian was joking. We're not right often, but every once in a while we actually hit it right on the head, and this is really one of those cases. When you look at like Mass Hub, which is kind of a good proxy for New England as a whole, we're about 7.5% higher on a 12-month strip than we were 2 months ago. West Hub, which is again our proxy for kind of the PJM area, it's about 3.5%. New York, we're up about almost 6%, and then we'll circle to Texas towards the end of the conversation because it's its whole other can of worms this year.
Yeah, Elliot, why don't you take Texas? I think that's our next slide because I was saving the best for last. But go ahead, you're on a roll.
Texas is where it's gotten really exciting. As you can see by this graph, the 12-month strip has skyrocketed over the past few months. There's a number of reasons for that. There's been a large amount of retirement of coal generation in Texas. In addition to that, or because of that, that has resulted in a very low reserve margin. Reserve margin being the additional generation capacity above and beyond expected peak demand. And that number has dropped down into the single digits by ERCOT's calculation. Some of the wholesale traders and counterparties that I work with on a day-to-day basis even think that might be a little bit of a rosy perspective on things, and it could be into the low single digits, talking like 3-4% reserve margin. Which all that takes is one large generating unit to go offline, and that's going to send prices skyrocketing up into the $9,000 that $9,000 price cap pretty quickly. It had been pretty well isolated, these price spikes to the August strip. Having grown up in Texas, and I know some of you are in Texas, August in Texas is about as miserable as it gets. When we were looking at this back in late November, August prices were $90 a megawatt hour. As of today, we're looking at $243 a megawatt hour for August pricing. That started to bleed over into the July pricing as well. July can also be a very hot month in Texas. As of today, it's about $137 a megawatt hour versus $60 a megawatt hour back in November. What's the recent trend, though, has really been in June with this early blast of heat in Texas, having 100 plus degrees, and really for a whole week. It was hot over this holiday weekend. It's hot all week, and then into next weekend, they're predicting, 105 in Dallas is the last forecast that I saw over the weekend. And that's caused the June strip to also, or the June price to also jump up into the $100 range. So we're looking at 3 months in a row of over $100 when our average price in Texas is somewhere in the, I would say, $30 to $35 range. So really, really high pricing in Texas right now. Again, this is something Brian and I have been banging the drum pretty hard on. If you have customers in Texas, get them locked in. We've already seen a number of $3,000 prices in Texas, for an hour here, an hour there, and that's in May. And this is even before this heat wave is rolled through. Continue to think that Texas is going to be extremely hot for the summer, both hot from a temperature perspective, but also from a pricing perspective. Brian, I don't know if you have anything to add to that about what we've been seeing in Texas and expecting in Texas.
No, I think you hit it all. The only issue I saw was week over week. The June price point change was what you said, something like $30 week over week, just for June in Houston.
Yeah, the
right?
June price went from, so on the 22nd, it was $72 a megawatt hour, and this morning it was $109. So almost a $40.
That's unheard of.
Yeah, it just doesn't happen. It's one of those that you wish you had that, as a trader, you wish you had that $70 and we're selling that off today. As a consumer, it's, the exact opposite, obviously, and as you guys look to help protect your customers from that risk and that volatility.
And the only other thing I would add, Elliot, if you don't mind, sorry to interrupt, but the only thing I would add is, I know that probably the reaction is, I can't call somebody now and talk about locking in power when it's moved up this amount, but I think anybody who's on a variable price is going to want to hear from you about options.
Yeah.
If somebody is on a floating price contract now, there is an extreme amount of pain, and it's going to be worth the time to explore different ideas, and then keep an eye on the market, and then take an educated and strategic look at how to manage some of that stuff when the volatility swings the other way, and kind of help try to manage those price points, because it will. Everything, you're not always going to be printing these kind of numbers, and I think the calls you should be making now are to variable price points customers in ERCOT if you have them on the line, because I think they're going to want to hear from you.
Yeah, anybody that has any exposure to the market right now, to really echo Brian, being exposed to the variable market or the real-time market in Texas, particularly for any business user, it's playing with fire. It could work out, but everything that I've been reading and hearing and talking to people, expectations are for north of 20 hours of $9,000 pricing, and 9,000 is obviously the cap in Texas. But if we're having 20 hours of $9,000 pricing, that means we're probably having, double that, where you're pushing into the $5,000, $6,000 range, which outside of Texas is unheard of. The price caps in all the other markets are $1,000 to $2,000. So we're talking about really extreme volatility in Texas. That while yes, you might be locking your customer in at a somewhat high, or actually in the grand scheme of things, a high price, it's going to be protecting them against the risk to the upside. And we really do see that the risk is to the upside. And there's very little risk that they're going to be locked in and not, and be like, boy, will nothing happen this summer. We've already seen it started to happen in May, and it's only going to get worse.
And I think that, Emily, if I'm not wrong, are there any other slides? I think we're done with that. Yep. Okay. So what does this mean? I think we just explained that part.
Yeah. The only other big news of note recently has been the PJM capacity auction for 2021-22, which occurred in the beginning of May and has now cleared. Capacity prices, RTO, so for the regional transmission organizations, so that's PJM wide, were $140 a megawatt day. Current planning year that's about to go into effect on June 1st was 164. So the 140 is relatively high. Basically, it's the third highest regional RTO wide price. There are certain markets that have an adder on top of that. Some of the transmission areas that are a little constrained have a little bit higher pricing on top of that. And really what that's saying is that, it's more expensive to own and operate and maintain a plant to be there, given all of the additional constraints on the system that's coming from additions to renewable capacity, and additions to requirements to perform for these generators to get capacity payments. The biggest news coming out of the auction was very little nuclear power cleared the auction, which just further increases the likelihood that we will see more plant retirements on the nuclear side. Nuclear is baseload power. It runs at a flat output, 24 hours a day, 7 days a week. So as you pull more and more of that baseload generating capability out of the generating stack, the likelihood that's going to be replaced most likely by natural gas powered generation, which brings about an increased chance for volatility. Volatility is not always a bad thing, but what it does do is it scares the traders, and so they become more conservative and start hedging at higher prices. So although we are in a high price point, a relatively high price point right now, it's not likely to decrease going into the future as we become more and more reliant on natural gas. So that was kind of the big takeaway is that nuclear is becoming less and less economical to run, and therefore gas is gonna pick up that slack, and more gas generation very simply equals more volatility. Haven't gotten any questions in at this point. If anybody has any questions, we'll take a quick pause and see if anybody wants to lob in some questions via the GoToWebinar application, and then we'll go from there. Brian, any other kind of big takeaways as we really start to enter the summer months, other than, in Texas, although it's high prices, still a good time to hedge and take that volatility off the table? What about the other markets? What are your thoughts on in the next 2 or 3 months? Are we going to see a buying opportunity, or is this as good as it gets? And if you have any exposure, now's the time to do it.
Probably the latter. I think all things being equal. I mean, nukes aren't going to leave the system right away. So I don't think it's a 2018 summer problem. But price volatility in gas curves does translate into power curve prices, just not as egregiously in Texas because gas sets the marginal price. But yeah, I think Northeast and New York markets, depending where you're at. I mean, we use New York Zone J. It's a big proxy, but it's important to pay attention to the geography because Zone A all the way out in the west in the Buffalo area prints at a fraction of what Zone J does. So don't just hear the Zone J story and think, oh my God, I got to do something and everywhere in New York. So if you got New York customers, there's a lot of regional variation in their price points. so geography matters. Eastern PJM, you know, while there is headroom in some of those Atlantic City and Jersey markets, I think it's a good time to go fishing in there and go hunting because, you know, rising curves come out in the standard offer service price comparison eventually. So I think eastern part of PJM is a lot more volatile than the western part of the footprint. So I would focus there. I think the likelihood of seeing higher prices there is probably going to continue. And the fact that there is headroom, I think, makes it a fertile ground to go do some work.
So haven't seen any questions coming in. So I think with that, Emily, we'll hand it back over to you. Thanks everybody for taking the time out of your day. And if any questions do come up, funnel those through your box representative, and Brian and I will try to jump on those as quickly as possible.
All right. Well, I'd like to thank Elliot and Brian for sharing with us today and everyone else for joining. If you have any questions that weren't answered or think of anything at all, just feel free to email your account manager or broker support at brokeronlineexchange.com. Thanks again, everyone, and we hope you join us next month.
Thanks very much.